Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The market has been a very interesting and rewarding place for investors over the last few years. So there's been a trend of DIY investors seeking advice from more formal or experienced sources. Now, as a consequence of this, you're seeing some people fall victim to certain scams that are running on social media channels, and it's time to talk about how investors can prepare for an advisor. Firstly, this journey from being a DIY investor to an advised client can actually come with its own set of challenges, because the way that you're managing your wealth, the level of involvement that you have, and the style can change in this process. So while it's important to know that, it's also important to protect yourself and choose the right advisor. The first and simple check that an investor can do is to check whether the entity or the person that they're going to work with is registered with SEBI as a registered investment advisor. RIA regulations are quite stringent and very much in favor of the investor and are expected to protect the investor's interests at all costs. So when you get into the RIA regulations, the first thing that you'll notice is that SEBI RIAs actually have a strict advertisement code. So it's very unlikely that they'll be soliciting for business at a large scale. The second and most important thing is that SEBI registered investment advisors cannot guarantee any returns, and this is quite commonsensical because there are no guaranteed return products in the market. The third important indicator is that SEBI RIAs are likely to want to foster very long-term relations with their clients and would look at working with you for years put together. The fourth and most important thing is there won't be any severe or serious product push. And if you're uncomfortable with a particular product or platform, there would always be alternatives available for you. So if you notice any of these things in somebody that you're engaging with, then you might want to check and look at their registration status, as well as whether this is something that you want to go forward with. To make the most out of your advisory relationship, you should be able to communicate openly with your advisor, and to have that level of trust, it takes a little bit of time to build that up. But what can help is managing your expectations and setting them very clearly in the beginning. So you might want to discuss how frequently you will communicate with each other. You might want to discuss what the responsibilities are, how execution is going to take place, what kind of follow-ups you would like, and how responsibilities will be split between the advisor and the investor. Once you get comfortable with the investor and advisor relationship, you should realize the power of actually following through with advice and listening to your advisor. At the end of the day, what the advisor tells you benefits you more than it benefits them. When you listen to the advisor, you're able to implement certain action plans that are in line with your goals according to certain timelines and risk parameters that you have defined as your comfort zone. Not listening to an advisor allows them to perform their responsibilities, but then the onus falls on you to actually create that wealth. We hope this video helps you find the right advisor and helps you stay away from certain scams or frauds that you're seeing in the market.